And now, it's Boomer Life, lifestyle discussion designed to make your life more engaging, meaningful, and complete. Celebrating the baby boomer generation, this is Boomer Life on CIL 650.
Help! I need somebody. Help! Not just anybody. Help! You know I need someone. Help! When I was young, so much younger.
And welcome to Boomer Life on CIL 650. I'm Joanne Sutton, and on Boomer Life today, we're talking about your financial future. Most Canadians are predominantly conservative in nature, but recognizing that some risk is necessary in order to achieve their long-term financial goals is exactly what Jim Doyle is all about. A well-thought-out plan for your financial future is an integral part of building the life that you want for both yourself and for your family. Jim Doyle is a senior financial consultant with Investors Group. Now, Jim, I know you hold quite a number of designations in wealth building, risk management, divorce, trusts and estates, and as well as international wealth management, and that you work in the advice channel. Your commitment to ongoing education is undertaken in an effort to bring value to your client relationships, and among those, you hold a certified financial planner certificate, so you're a CFP, a CLU, a chartered life underwriter, TEP, registered trust and estate practitioner, a CDFA, a certified divorce financial analyst, and a CIWM, certified international wealth manager. Now, Jim has had numerous articles published in the Financial Times, also the National Post, the Province, the Vancouver Sun, and he is a frequent contributor to Business in Vancouver. Jim has appeared on the City TV Morning Show and the Bill Good Show, as well as the Family Matters television series on Check TV with Judge Harvey Brownstone speaking on wills and estates, as well as a segment on family, finances, and divorce. So, Jim Doyle, I would like to welcome you to the show today. Welcome to Boomer Life. And I know we've just heard a lot about you, but I know there's a lot more. Maybe you could expand on that. Tell us something about yourself that we don't know already.
Well, thank you, Joanne. This is a pretty special time of year for myself and my team. We like to find ways to give back throughout the year, whether it's by entry to our seminars, by donation to the food bank, or whether it's dropping off Christmas trees to families less fortunate. This year, we helped out by hosting a Christmas dinner yesterday at the Harbour Light downtown East Side location. That was a lot of fun. It's really an honor and a privilege to be brought into our clients' Christmas plans as well. They share their excitement, their expectations, their holiday plans, and what's going on with their family, as well as what's going on in the new year. It's almost like we've been made part of the family.
Excellent. Thanks for sharing that. So basically, in the first part of today's show, we are going to learn a little bit more, or maybe a lot more about Jim. We're also going to talk a lot about money and family and build this relationship over the weeks and months to come. We will learn more about you for sure. So let's start today in general by asking, why should our listeners want to work with you?
I think it starts by helping people filter out the noise and sense of overwhelm when it comes to making financial choices. This is where we bring the real value. It's about understanding your defined goals and objectives, and that they need to be aligned to reflect current opportunities, challenge market conditions. And it's important for me to connect with your experiences, ideas, and values with an articulate approach to sharing your vision and sense of purpose. I bring confidence and experience to the equation. I'm action-oriented and accountable. That's why I think people should work with me.
Money can be quite a sensitive issue, so let's start with the basics. Why is it so important to have a written financial plan?
Well, do you know the number one fear of financially comfortable Canadians is? It's going broke in retirement. Money is a bigger source of stress than work, health, or relationships, according to a new survey by the Financial Planning Standards Council. The survey found that financial stress is causing Canadians to lose sleep, reconsider their past investment decisions or financial decisions, argue with their partners, and lie to families and friends about personal finances. It says 51% of women and 40% of men report losing sleep to financial worries. 45% that say they're embarrassed by their lack of control over their finances, and 40% of those shared finances argue regularly over finances.
I've heard of people getting divorced after arguing over finances. So the numbers sound appropriate.
Now here's the sweet spot, and you know it was coming. The Financial Planning Standards Council also says that people who engage in financial planning report significantly higher levels of financial and emotional well-being. To get full value from financial planning, you need a financial plan.
So don't most people feel confident having an investment plan? Isn't that enough?
While an investment plan can help with investment selection, I'm not sure that it provides the confidence or exploration of options that need to be considered in addition to risk and investment selection. I can't stress just how many other aspects are important to be considered in a financial plan that goes beyond simple investment selection. I get the sense that when it comes to money, people would like quick and simple solutions. Unfortunately, some matters require a little more exploration and a little time.
And not to be scared about that either. But could you expand a little bit more on the differences between an investment plan and a financial plan? I know that they are two very different plans, but equally important, and I think a lot of people still confuse the two.
Joanne, that's a great place to start. But can we start by talking about the differences between an investment advisor and a financial planner?
Okay.
We should probably talk about how the processes and the outcomes are quite different instead of focusing on an end product. In fact, you'd be surprised at how many people believe investment advisors also provide comprehensive financial planning advice. Most financial planners are investment advisors, but not all investment advisors are financial planners. Some financial planners assess every aspect of your financial life, including savings, investments, insurance, tax, retirement, and estate planning, and help you develop a detailed strategy or detailed plan for meeting all of your financial goals. You should always walk away understanding how your investors get paid, and if the advisor or financial planner, or which it is that they are. Before you hire any financial professional, you should know exactly what services you need, what services the advisor or professional can provide, and limitations on what they can recommend, as well as what services you're paying for and how much these services cost.
Yeah, very good point.
I'm often surprised by the number of folks who don't know how their investors or advisors are paid. Investment advisors only give advice on investments. They help establish their clients' ability to handle up and downs in the markets, set goals for their investment funds, and make recommendations on how the client should be invested. But remember, the primary focus is on the client's investments. If you're a seasoned investor, it's possible you may not require much help making investment selections. That doesn't mean you couldn't benefit significantly from financial planning advice. Investments are probably only about 20% or less of what financial planners do. I think it's a great time to be an individual investor. The gap between investment advisor and a financial planner is getting wider. We suggest analyzing your own financial situation and deciding whether you need simple investment advice or a more comprehensive plan to reach your life goals.
So part two of this conversation would be, can't I get financial advice from a financial planner at my bank? Isn't that the easiest place to start?
I'm all for working with an advisor who checks in with the investor on a periodic basis and who promotes good financial behavior, encourages commitment, reviews goals, and encourages third-party accountability. But within the banks, keeping the same advisor over a long period of time can be quite a challenge. I think you might want someone who knows you, your story, warts and all, and can grow with you. I had a client once who feared her advisor being promoted and transferred to another branch. She said, "I don't want to have to break in a new advisor."
Oh, so this is a fear. Now, you mentioned earlier that one of the biggest fears was running out of money for retirement and not having enough when that day shall come. A lot of retirees have built a lot of value in their homes, and they're depending on using this asset in their retirement. Is this a good thing, or could this be a risky strategy?
Well, personal savings, investments, pension, and government programs would be the foundation of your retirement income, not your home. Still, there's an opportunity to improve your financial position by downsizing your home in retirement and investing what's left over. Deciding how you're going to access the equity in your home can be a real challenge, and it's not as easy as one might think. Options could include a home equity line of credit, a reverse mortgage, downsizing, or selling. Now, I'm probably not going to be able to cover all of the details I'd like to here, so I'd like to encourage people to speak with their professional advisors before they implement any of what's explored here. A home equity line of credit allows you to borrow up to 65% of the value of your home. This is one of those things that's probably best to explore before you retire, even if you don't need it immediately, as it can be more difficult for retirees to qualify once they're retired. Changes in interest rates or future cash flow changes could also see payments not be affordable. A reverse mortgage is a loan that you don't pay off or make payments on until you leave the home. Interest accrues on the money advanced, usually between 10 to 50% of the value of the home. Rates are usually higher than a conventional mortgage, and some provide an option for multiple advances. However, watch for future refinancing issues.
Can you just give me an example of what those refinancing issues could be?
Well, a good example, if you need to take more money or to renew an existing mortgage, sometimes these institutions don't want to be held in a second position. So you might not be able to access as much equity when you need it.
Or as much as you thought you might be getting.
Precisely.
Okay. So in planning for retirement, what about just downsizing or selling your home? Surely everyone says you should downsize, and nobody wants to clean the big home that, they'd been looking after while raising children, etc. But moving into a smaller home is supposed to solve a lot of problems in retirement. This is what I understand.
Well, downsizing isn't always simple or painless. There can even be the emotional pain of scaling back. Imagine sorting through 30 or 40 years worth of stuff in the basement and deciding what to keep and what to get rid of. Now, I want to throw out a helpful hint here if I could. This could be a great time to take pictures of the home before the home is dismantled, saving the memories, not all the stuff. Now, equally challenging can be adult children who feel this is the family home where they grew up, and they have issues around their parents considering downsizing. If you're downsizing in the same city, retirees are often surprised at how little the financial windfall is, or that expenses didn't fall as much as anticipated. You need to consider if you're going to invest a difference for income, or if you're going to use the leftover funds as a saving account to, say, pay for trips, help out the kids, or whatever. Money you anticipate spending in the next 3 or 4 years, you probably should put it into something safe. Whichever method you choose, using your equity in the home is a major decision that needs to be considered carefully. Once it's used, you may not have a fallback plan that you like. Consider your current age, health, projected cash flow. These are all important considerations. So here's where you're using a written financial plan can help model some of the choices and outcomes.
Basically, you're going to hold our hand through the whole process.
I'd love to.
You've been listening to Boomer Life on CL 650. I'm Joanne Sutton. Today, we're speaking with Jim Doyle, Senior Financial Consultant with Investors Group. We're talking about understanding and avoiding some financial missteps that a lot of people make for all the wrong reasons. For more information and to get to know Jim a little bit better, you can go to his website, jimdoyle.ca, or you can call him toll free. I have a number for you. It's 1-800-665-7178, or locally you can call 604-682-5431. There's still a lot more to come with Jim Doyle, including some thoughts on downsizing your home, which we were just talking about. We'll expand on that a little bit more, and some of the considerations that you might want to look at. It's all coming up next on Boomer Life on CL 650.
Celebrating the baby boomer lifestyle. This is Boomer Life on CL 650.